Hello and welcome to Your Money, Their Hands. And this week, we're back at Jupiter again, this time to talk to Philip Ehrmann. He's the manager of Jupiter's China Fund. Philip, of all the indices in the world that have done well in investment markets, China surely is the success story of 2009. Can it go on?
Oh, absolutely. I mean, China is really playing out what we've seen elsewhere in the world, which was a very sharp collapse in 2008, which took valuations to, in some respects, absurdly low levels. We fell back to levels I hadn't seen since the SARS crisis in 2003. And frankly, I didn't expect to be able to access and enter the market at those sorts of levels. So as China then confounded many of its critics by delivering strong economic growth, companies coming through with much better earnings than people expected, it wasn't a great surprise that one actually had quite a sharp uplift in the market. But only a relatively small proportion of that was due to re-rating. I think we're still at what I would call reasonable levels of valuation. Most of it's been driven, to my mind, by very strong earnings recovery.
We've seen some commentators suggest that the fiscal stimulus that the Chinese government has put into the economy is creating an asset bubble not dissimilar to that in its neighbour Japan in the 90s. I mean, what do you say to them?
I think that's, I won't say fallacious, but it's taking 20 or 30 years of history in Japan. I mean, the bubble in Japan evolved over a very long period of time, and it's compacting it and deciding that China's delivered that in a matter of months. I don't believe that's the case. I do think that there is a risk over a multi-year period that if China were to keep a very, very easy monetary policy and indeed government state-sponsored lending continuing the way it has done in the last year, there would be a problem, no question. However, we need to go back and look at the last 12 months. They've been extraordinary. And to my mind, the Chinese authorities probably come through with very high marks in terms of how they've managed to keep the economy on the rails during a very, very tough time for the global economy. And so one needs to look at the fiscal package in that light, and indeed, whilst very, very high and eye-bulging numbers in terms of 4 trillion renminbi of stimulus, the reality is there was a lot of double counting. They were reaching forward a little bit into 2010 and 11 for some of their economic programs. And so the real number is far less than that. In terms of the bank lending that everyone has pointed to in the first half of this year, which literally exploded into life, a good part of that was short-term lending to provide liquidity to corporates to get them through a tough time in terms of carrying inventory and problems with accounts receivables that might otherwise have occurred. What I found pleasing is that really from June, July, August, and indeed again in September, we've seen this short-term lending rolling over and coming off. And ironically, people are now complaining, oh my gosh, bank lending is too little. The reality is somewhere in between the two. And I personally think that the Chinese authorities, as we move forward, will act in a counter-cyclical fashion. So as consumer sentiment and the property markets, and indeed even the export industries, begin to stabilize as they're now doing, you'll find the government hand just pulling back a little bit. Now, I don't view that as slamming on the brakes. I view it as a graduated and plausible and sensible response.
What about the renminbi? You mentioned it there earlier. A lot of pressure, not least from the Eurozone and from the Americans, saying you have got to let the value drift up. And they don't seem to have heard that argument, do they? Is that going to cause a problem for investors like you and the people who invest in your funds?
Well, at the moment, there isn't too much of a problem because, frankly, most currencies haven't performed particularly strongly against the renminbi. I suppose the euro has appreciated, but the dollar-sterling relationship is not greatly changed. I personally think that the renminbi will drift up 10–15% over the next 18–24 months. There's no indication it's going to happen imminently. We do know, obviously, President Obama is due to visit China, and there will no doubt be frank discussions about many things, including how they both approach the Copenhagen summit in terms of climate change in December, which I think is a very important flashpoint, if you like. But in terms of trade, you're quite right. I think that not only the European trading partners, but also the Asian trading partners, bear in mind that the renminbi has been tied to the dollar, and the dollar has in many cases fallen in relation to the yen, the Korean won, Taiwanese dollar. So China's relationship, obviously, with its trading partners, its more the growing economic bloc that is Asia, is certainly coming under some pressure. And I would expect that, particularly given the very substantive financial FX reserves that China has, that they will allow and begin to move to let the renminbi drift upwards, which should be very, very good for investors in China and in our China fund.
Excellent, Philip. Thank you very much indeed.
Pleasure.
There we are, a good investment story from Philip Ehrmann. He's the manager of Jupiter's China Fund. That's it for this week. Don't forget to keep up to date, please, with all the latest news, views, analysis and trenchant opinion online and, of course, in the Saturday and Sunday papers. Thanks for watching, and please do join us again next time.